The FOMC, the Federal Open Market Committee, the interest rate policy setting organ of the Federal Reserve System, speaketh. And we have Gigi Stone from the Big Apple with more on the decision, or Gigi, as the case might have been, non-decision. What did they do? What did they say?
Yeah, pretty much, Bernie. Non-decision. No big surprises. Analysts said the Fed's task was to strike a delicate balance between highlighting recent growth while assuring the markets the Fed will still be there to ensure a lasting recovery. They appear to pretty much have done just that, leaving the benchmark interest rate unchanged at a range of 0 to 0.25%, saying it will stay, quote, exceptionally low for an extended period. Analysts say
I don't think the Fed
right
needs to be
do.
in any rush to start ratcheting rates up even then, because I do think we have at least probably a 2 or 3 year window before any pricing pressure could ultimately result in inflation.
Now, the big question ahead of today's meeting was whether the Fed would extend the end date of its $1.45 trillion program to buy housing debt into 2010. Well, the Fed did that, saying it will, quote, gradually slow the pace of these purchases in order to promote a smooth transition in markets. It anticipates they'll be executed by the end of the first quarter of 2010. That's 3 months later than scheduled. And back to the economy, the Fed said economic activity has picked up following its severe downturn, and activity in the housing sector has increased. Household spending seems to be stabilizing, but remains constrained by ongoing job losses. The Fed making the case it is still going to apply policy actions as needed to support growth and employment. As far as inflation is concerned, the big fear, the Fed repeated its view, inflation will remain subdued for some time. That is another example of things coming in line as expected, Bernie.
Sounds very prudent on the part of Bernanke and his folks at the Federal Reserve there. Let's get a little bit on the inner mindset and the inner workings of the Federal Reserve. Our guest this morning, first out of the gate, is somebody who spent many, many years with the Federal Reserve System. Indeed, between 85 and 07, he was employed by the Federal Reserve Bank of New York State in a variety of positions, and knows a thing or two about how they think and what they do and the kind of parameters by which they come to their judgments. Dino Coss is with us this morning. He is currently managing director at Portales Partners and a regular contributor here to Bloomberg Television. Dino, good evening to you. What did you get out of the Fed? If the pedal was to the metal, are they sort of lightly tapping on the gas right now?
Well, what they're trying to do is, good morning, Bernie. What they're trying to do is to provide reassurance that the recovery is on track. that was the first message. The second message was that the inflation continues, as was just said, not to be a problem. And then really the only element that was a bit of mystery was what would they do with these purchase programs. They are on track to buy almost $1.5 trillion, and that program was due to end at the end of this year. Now, what they were worried about was that there will be a cliff, if you will, that if they stop suddenly and immediately at the end of the year, that the market could not withstand that sudden withdrawal. So what they've done is to say, okay, we will smoothen out our acquisitions. We will extend the time period, not increase the size, but extend the time period so that their exit from this purchase program is a smoother one, and the market can adjust to this exit of this very large player. After all, the Fed has been buying, by some measures, between 3/4 and 80% of all the mortgages, the MBS that have been issued. So it's a significant factor in the market.
But the tone of the language, the market was a little bit unnerved by the fact that, last time they said we're going to use all available instruments, everything under the sun. It's a blunderbuss approach, and this time it's like we'll use a variety of instruments. You talked about the asset purchase program. They're $860 billion through the $1.25 trillion in agency MBS, and just shy of $130 billion of the $200 billion in U.S. agency bonds. I mean, it's like, why not treat it like a course of antibiotics and finish it? Because that would be a good thing for the market. You don't have inflation pressures that you got to battle right here, right now. Why not finish it? Why send the market a signal that you might almost be done, and then everybody goes berserk because, whoops, what happens to mortgage rates and the yield curve after that?
Well, it's a balance that they're trying to strike. So you make a good point about finishing it. On the other hand, again, they're worried about market dynamics to some degree, and they're worried that if they stop suddenly, that the market will not have a smooth transition. The other point to make is that when we talk about these exit strategies, is that to some degree, and all available tools, is that some of the tools are already being wound down. So a couple of months ago, they had a range of these liquidity programs that were at work, that were being used by the Fed. Some of them have been scaled back. Some of them have their expiration has already been announced. Some of the other programs that the government has used, like the money market guarantee program, that did expire a few days ago. The FDIC's temporary liquidity guarantee program, which guarantees debt, that's expiring at the end of October. So, I think what they're trying to say is, okay, we realize that some of the tools that we have used are expiring, and that may account in part for the language. The other thing is to try to reassure people that we are heading into a stage where the economy is doing better, and we don't need some of the extraordinary measures that we've used.
So with with all these use-by dates looming on the short-term calendar here, did all the big guns, the big ammo, did it take down their intended victims? Did we get the intended effect, or was it sort of a, I don't know, what was the ROI like on this big multi-trillion-dollar program?
Well, what they were trying to do was to stabilize the system. That was the single most important thing, of course, is stabilizing markets, stabilizing the economy. You can make the argument that that has pretty much achieved its goals. The economy, I think most economists would agree, the recession probably ended around May or June. You can argue with the month, but the recession has largely ended. The markets are doing better, and the credit markets have really opened up.
All right. Dino, hang on. We'll continue this chat. We'll talk G20. We'll talk about IPOs as Morning Call continues. Don't go away. Dino Koss from Portales returns to us from New York. They're very busy on Capitol Hill. Who's getting the most traction and attention? Did Geithner kind of fall on deaf ears given everybody looking toward the Fed for guidance today, Dino?
Well, that was part of it, but what's really distracted Congress is not so much the Fed. What's distracted Congress is health care. And so while there is a proposal that the Treasury has put forth to reform the financial system, redo the regulatory structure, it has kind of been the Congress has focused so much on health care that they haven't focused nearly as much on financial services. What's happened is that has left the lobbyists from the banks to really work on Congress. And they have successfully diluted a lot of what Treasury had hoped to do. So what I think in part what Secretary Geithner was trying to do today, as it were, was to regain the initiative, regain the attention of Congress, and convince them that they really had to do this, that it was important to take these important steps to reform the financial structure, to reform the regulatory structure, and to really do it this year, because the risk is that the more that time goes by, the more that some of these proposals get diluted, and there's always a risk that nothing gets done. I think that something will get done, but again, it probably will not be as ambitious as what Secretary Geithner had hoped earlier in the spring.
So it's not going to be the overriding kind of silver bullet then. What is it going to be? Is it going to be little tweaks that really kind of leave us in very much the kind of climate that we're in right now?
Well, I mean, I would say evolutionary rather than revolutionary. If you think back to the 1930s in the U.S. after the crash, there was just a very wide-ranging an overhaul of our regulatory structure and our financial system. Things like Glass-Steagall separating commercial banking from investment banking and the like. Well, nothing like that dramatic is going to happen. They're really talking about steps that are more evolutionary, fixing derivatives, doing work on consumer protection. They also have been talking about two important points. One is the so-called systemic regulator, and the second thing is a resolution authority to wind up non-bank financial companies. I mean, this can get rather technical, but these are really important provisions that the Treasury really wants to get accomplished. And right now the betting is only 50-50 as to whether these provisions that they really care about actually will happen. So I think, again, Secretary Geithner wants to push them to move it sooner rather than later before, again, the forces of inertia kind of push back.
All right, Dino, finally, in our last half minute, I know you've been watching the credit markets and the tightening of spreads quite carefully, and that has probably the most important implication for people out there in the market. Give me your best shot.
Well, we've just had an amazing rally in credit over the last couple of weeks. And again, some of the names that a couple of months ago, there's no way that they would have had access to the market have really been welcomed by fixed income and equity investors. Most recently, airlines. Now, airlines, this is a business, of course, that has had so much trouble over the last few years. And what we've had is earlier last week, American Airlines raising $2.9 billion, raising equity this week, and then raising more debt today. So they raised about $4 billion in less than a week.
Okay.
Delta Airlines raised $250 million. So these are, again, interesting businesses. Could not have raised money months ago, are raising lots of money now.
All right, thanks for your time.